뉴욕나우. 안녕하세요. 글로벌 시장에서 통하는 투자법을 알려드리는 뉴욕나우 한국경제신문 강영연입니다. 제가 뉴욕 특파원으로 준비한 마지막 인터뷰를 오늘 하게 됐습니다. 제가 이분을 인터뷰할 수 있어서 개인적으로 굉장히 큰 영광이고요. 여러분께 이 인터뷰를 전달할 수 있어서 정말 기쁩니다. To introduce him, I think no explanation is necessary. His name is enough. Today we are meeting with David Rubenstein, founder and chairman of Carlyle. Carlyle is one of the biggest private equity in the world. At the same time, he is a best-selling author as well. Hello, David. It's an honor to meet you. Thank you for joining us today.
Thank you very much for taking the time to interview me.
As I mentioned before, you are not only a legendary investor, but also a best-selling author. I know that you will release a new book next month. The title is How to Invest, that contain your investment experience, principles, and interviewed with great investors. I'm really looking forward to your new book.
Thank you.
In today's interview, I'd like to talk about your investment principles and current market conditions. First of all, you have summarized 13 traits that great investors have in common in the book. If you pick three of the most important things, what is it?
If I were to say three things that great investors have in common, probably the three most important would be, one, a willingness to defy conventional wisdom, which is to say that they're willing to do things that other people tell them is not probably a good idea. Secondly, they tend to be very good in mathematics, and they tend to have a very good sense with numbers. They also tend to be willing to admit mistakes and move on when they recognize they made a mistake and go on to the next thing. They don't sit around and keep saying, well, no, the market is wrong, I'm right. So they tend to, when they realize they've made a mistake, which all of them do realize at some point, they go on. But generally, I would say they tend to come from blue-collar families, middle-class families, not very wealthy families. They tend to be reasonably well-educated, and they tend to have been interested in doing something else in their life when they were younger than becoming an investor.
You cited recognition of mistake as a common trait of great investor. At the same time, you said you couldn't accept a mistake and move on. What is the most difficult to admit a mistake you have ever made in 10 years? For example, not recognizing Facebook and Amazon.
If I was a great investor, maybe I would have moved on more readily, but I'm not saying I'm a great investor, so I'm probably not in that category. But I have had a harder time moving on in terms of forgetting about the mistakes I've made. Just like fishermen like to talk about the fish that got away, and they always say how big the fish was that they almost caught. I like to talk about, I guess, the deals that I almost did. And two of them are ones that you've cited. One is, and I put in my book, one is Facebook. When Mark Zuckerberg was at Harvard, I heard about it through my now son-in-law, and I didn't think it was going to go anywhere, so I turned it down. And then with Amazon, we had a relationship with Amazon at the beginning, but we didn't think it would be successful, and so we sold our stock early. Those are big mistakes that cost us a lot of money, but what can you do?
Are you regret about the decision?
I do. I wish when I met Jeff Bezos the first time, I said, you're never going to be able to beat Barnes and Noble. They're too big. So, don't waste your time on doing that. He didn't really agree with me, and he was right.
When you interviewed several investors, who did you sympathize with the most and why? What trait do you sympathize with him or her?
Well, all of these investors are very, very successful. So I don't know that sympathy is the right word to describe the relationship I would have with them, but I would say some of them overcame greater hurdles than others. For example, a woman named Kim Liu, who is part Chinese, part African American, came from a very modest family, and she managed to overcome some of the prejudices that existed toward her, and now is the head of the endowment for the Columbia University. The fact that she was able to struggle and overcome some challenges, made me think she's a very, very persistent person and obviously very talented.
You met legendary readers in your previous book, How to Read. What are the differences and similarity between the people you met in the How to Read and the people you met this time?
Well, they do have a lot of things in common. They tend to be persistent people. They've had failures in life. They pick themselves up and move forward from the failures. They also tend to be pretty smart people. I'd say the differences is I think that in How to Lead, I was talking about people have a variety of different qualities. Some are good at leading in politics. Some are good at leading in business. Some are good at leading in other areas of human endeavor. Here, we're really just focused on people that are really good at one major thing, which is investing money and making a profit on it that's considerable. And it's a different skill set. If you're a great investor, you're not necessarily going to be a great politician or even a great executive or a great educator. So it's a different skill set. But there's no doubt that they do have in common the fact that they have persisted, they have defied conventional wisdom typically, and they have overcome failures.
You choose Warren Buffett as your most expected investor. Can you explain why?
There are a lot of great investors in the book. Warren Buffett is unique in that he's been doing investing for a longer period of time with a higher track record than anybody. He bought Berkshire Hathaway, a publicly traded company, for $7.25 a share 60 years ago. In the ensuing 60 years, he's averaged returns of 20% a year for 60 years. So no other investor has achieved that high a rate of return over that long a period of time. Obviously, there are very few people who have invested for 60 years. But so he's very persistent. He kind of has a view and he sticks with it. And he does it by himself largely. He doesn't have a team of hundreds of people helping him. So I would say he's probably the most admired investor by me and probably by most people in the world.
You gave various advice to individual investors in your book. You gave 11 thoughts to investors who invest directly. If you have to pick 3 of the most important things, what is it?
When you're investing directly and you're doing the deals yourself, I think the most important things are to know what you're doing, which is to say, read everything you possibly can about the subject matter, and be prepared to lose money, and therefore don't put too much of your money in any one investment. Diversify, in other words. So I would say diversification is important. Know what you're doing is very important. And then I would say also probably having good partners, recognizing that you need to do things not just by yourself, but having a partner that can help you, who can overcome some of your own weaknesses and compensate for those.
Do you think most of individual investors don't know what they're doing?
I think most individual investors don't do enough research on what they're going to do with their money. I would say very often they'll invest money based on very, very little research or very little reading. A friend of theirs might have recommended something, but they don't tend to do as much reading or research or have as much knowledge as you would think they should.
Concerns over inflation and recession that have not been experienced in recent decades are growing. In this situation, how do you think individual investors who invest directly should behave? Most of them are novice investors who started investing in the bullish market that continued until last year. They are very worried about the market. If you have any advice for them, and how do you predict the market?
The most common mistake the average investor makes is when the stock market goes down, they get out of the market. And when the stock market's going up, they get in the market. In other words, they're chasing higher prices and they come in at too high a price and they get out before there's opportunities to buy things at lower prices. So I would say that the most important thing that investors should know is about the current situation is that we've been through these kind of cycles before. The world will continue. The bottom fishing that is often done, which is to say buy things at low prices, is a good way to make money. Great fortunes are made when markets are in distress and when they're low. So not being afraid to buy things because the company's had a problem for a while or the stock is low is a very important attribute. Yeah, I think there's a lot of opportunities now to buy things at low prices compared to where they were just a year ago or 6 months ago.
Do you think it is a buy the dip opportunity for individual investors?
Well, individual investors, they're very commonly, they just get out of the market at the wrong time and they get in the market at the wrong time. I think currently is probably a pretty good time to invest because prices have come down. Inevitably, they'll come back. And so my advice to investors now is not to panic and run for the doors, because actually these companies, in many cases, are good companies, not every one. But if you know what you're doing, don't be afraid because the stock price is going down or the asset's worth less than it was 6 months ago, because inevitably it's a good company. The markets will come back.
Are there any good stocks or sector you are keeping an eye on this backdrop?
Well, I'd say no one in particular that I'm going to cite, but I'd say right now, technology companies have been beaten up in terms of their stock price. A lot of these companies are excellent companies, but all of a sudden the market doesn't like technology companies. And so I think they are ones that have been beaten down a fair bit. Some finance companies, private equity companies, for example, their stock prices have gone way down, and they're probably pretty good buys as well.
You gave 10 perspectives to investors who make indirectly investment, such as funds. If you have to pick 3 of the most important things, what is it?
One is make sure when you're investing with somebody else, make sure you know what their track record is, because that's a very good indicator of future performance. Second, I would say make certain that those you're investing with are putting a fair amount of their own money in the same investment you're doing, if they're legally able to do so. And third, find out who the other investors are, because generally smart people know how to find good investments. And if you're investing in a fund or some kind of project that nobody smart or nobody well-known is investing in, that might not be a good sign.
Looking at your investment principle in the how to invest, it seems to emphasize that the possibility of investment success should be increased through preparation, research, and investigation rather than luck. And you emphasize that investors should have realistic return expectations. There is some prejudice that private equity is adventurous, but your investment principle seems to conservative. Please briefly explain your investment principles and why you set them.
I'm trying to give advice to people that is designed to help them, make money and try to do so in a way that's reasonably conservative. I don't think the average investor should expect that he or she is going to make 30% or 40% returns a year. And so I'm trying to give advice that is conservative, one that seems sensible to me. I'd say private equity used to be considered very adventuresome and adventurous, but now it's less so if you invest with people that really know what they're doing and have a long track record. So I think things like cryptocurrencies are much more adventuresome today and potentially potentially dangerous than private equity. Private equity is relatively established today.
You said cryptocurrency market is adventurous and risky. What do you think about the cryptocurrency market?
Well, my view is that cryptocurrencies are probably not going to go away. There are many people that really like cryptocurrencies because it's an effort to own something that the government doesn't control and doesn't know you own, and you can transfer it fairly readily without government interference. And there's still a lot of interest in that kind of activity. While cryptocurrency prices are down by at least 50%, if not more, there's no doubt that there still have some value there. So some of the people I interviewed in the book, like John Paulson, think that cryptocurrencies are worthless and people shouldn't buy them at all. But somebody else like Mike Novogratz, who I interviewed, who's a big investor in cryptocurrencies, think that the world is changing and younger people recognize this, and younger people tend to be more focused on cryptocurrencies than older people.
Why do you write this book? You are very busy and success. Moreover, you are rich enough.
Well, I guess I enjoy writing. I enjoy interviewing people. Obviously, you do as well because you're in that business, right? You interview people. I think as a general rule of thumb, people who think they have something to say often like to write books so they can get other people to know their own thoughts. And so having spent 35 years in the investment business, I thought it would be a nice idea to maybe give people some of my own thoughts on investing. And, people can judge whether they're good or not. but I enjoy writing and I enjoy the interviewing process.
Do you have any books to recommend to subscribers who are interested in investing?
Well, there are a lot of good books. So there's an earlier book on great investors that has been written before, but there are other books that are like this. But yeah, I think one of the best books I've read in recent years about investing is a book called Snowball, which is a book about Warren Buffett. And it really does a better job than any other book I've seen on explaining Warren Buffett's investment philosophy. And I would highly recommend that book as well.
You interviewed Ray Dalio, Larry Pink too. One is the president of the largest hedge fund in the world, and the other is the CEO of largest asset management company. Who is smarter?
Well, I like to ask questions like that, but I usually don't like to answer them because they're friends of mine. So I would say in their own way, they're both extremely, extremely smart and both have built incredible companies. As you point out, the biggest investment firm in the world and the biggest hedge fund in the world. And they're both done, I think their interviews are quite good.
You emphasize the social responsibility of investors. Some point out that ESG does not help investment.
Well, ESG is a relatively new phenomenon in the grand scheme of things and has risen up in the last 10 years or so. And I do think major firms are now investing in that area because they think that it will produce higher profits. The conventional wisdom was that if you focus on ESG, you won't get as high a rate of return because you're avoiding certain opportunities that otherwise would be good. Today, there's a general view that the best employees, the most desired customers, the best suppliers all care about ESG. And if you don't really focus on ESG, you won't have the best employees, customers, suppliers, and so forth. So I did interview a person in the book who's a big believer in it, David Blood, and his firm has done extremely well by pursuing ESG heavy practices.
It was my last question. It really was a thrill and an honor to have time with you talking about investing and markets. So much wisdom that you've shared with us. Thank you for joining us today.
Well, thank you very much. I would say in conclusion that my firm has been an investor in Korea, as you know, for a long time. We've made a lot of good investments there. And I appreciate your giving me the time to talk about my new book. So thank you.